move on from the role of the Fed and start talking about the next major force at play, right? This accelerating adoption of passive investing. So you said a Vanguard study showing that passive funds have grown from about 10% of equity fund assets to 45% of assets today, or, I don't know, maybe.
I think it just clipped over 50 from my last Morningstar report that I saw.
Oh, perfect. Okay, great. So we've got more recent information, right? So the effects of this mass migration can be seen in cross-sectional security pricing as well as an impact on market microstructure. But I know you did a lot of work, especially on your own, investigating the impact on cross-sectional security pricing and factor investing. So why don't we start there? What are you seeing?
Yeah. So before we go into this, I'm going to try to be as precise as I can with my language, because I think it's really important here. So when I say,
let's go to definitions. Good call.
When I say passive, I am going to mean something that is market cap weighted or within a stone's throw of market cap weighted. So Russell 1000, S&P 500, ideally a total market exposure, but sort of market cap weighted or significantly close to that. When I say indexed, I am going to mean strategies that follow an index passively. So this is going to include all smart beta products. And we'll get to that when we start to talk about the market microstructure. But that's going to be a really important distinction, that even though those smart beta products have an active tilt to them in terms of the active bets they embed, they are indexed in a way that I think is important and potentially influential in the market.
So passive is cap weighted, indexed is systematic, but not necessarily cap weighted.
Yes. Yep. So let's go to the passive, the influence of passive. So the idea here ultimately is that in active investors, and by the way, I should full stop. What I am going to say here is a mere subset of the expertise that someone like Mike Green has on this topic, who you've had on extensively. So I would highly recommend that everyone hits pause on this podcast and goes and listens to Adam's chat with Mike Green and then comes back, because Mike Green has done far more work on this and has actually been an incredible resource for me in sort of talking through some of these ideas. But ultimately, the idea here is that a flight from active to passive requires an unwind of active bets. The simplest way I can sort of think about this is looking at something like a value exposure. So let me see if I can pull up a chart from the paper really quickly. So when I think of, say, a deep value portfolio, here in the paper, I use the S&P 500 Pure Value ETF. There are what we would call active bets embedded in that portfolio. And active bets can really just simply be summarized as which securities are you overweight and which securities are you underweight relative to your passive benchmark. So in this case, looking at the S&P Pure Value ETF, all you do is take the weights and subtract the weights in the S&P 500, which is that passive benchmark. And what you see in figure 6 here is that it is predominantly underweight all the names on the left here, which are the mega cap growth names, things like your Microsoft, your Google, your Amazon. It is underweight to the tune of 5-6% and overweight sort of your smaller cap and, of course, value names. And so the idea here is that if you are a value investor and you capitulate and you move to a passive benchmark, you need to trade in such a way that unwinds this active bet. You are going to have to sell down all these securities you are overweight and buy up all these securities you are underweight. And in doing so, if you have a large enough proportion of people that are doing this, and you assume that the people who are instigating this trade are the ones sort of crossing the bid-ask spread, you would expect from a sort of supply-demand theory basis on the market, that this would drive down the prices of your smaller cap value securities that they're selling to cover and drive up the prices of the mega cap growth names that they now need to buy up to get back to their passive weighting. And so the idea is that if you have a huge proportion of people doing this, regardless of reason, whether it's because they're doing it from a performance chasing perspective, or whether they're doing it from a fee-based perspective. Or I've heard plenty of anecdotes about sort of a regulatory pressure perspective. The DOL rule that was proposed sort of in the 2015 era, I know caused a lot of advisors I worked with to start adopting passive strategies more aggressively. And in sharing this paper, I had a large number of advisors tell me that in recent SEC reviews of their practice, that the SEC would come in and point to certain funds that they had, more expensive funds in their portfolios, and ask them why they own that versus a lower cost alternative. And when you start, and again, to me, it doesn't matter what the answer is, why people are making this change. It could be a culmination of reasons. But if people at large are making this tilt away from active, which typically, depending, almost every style of active, value, quality, size, low vol, all of those embed a tilt that is largely away from these mega cap growth names, that a move back towards passive would ultimately bid up those mega cap growth names.
Yeah. So I think you got some really good feedback and pushback on your paper. And one reader suggested that if there was a switch from active in general to passive, that you'd expect an equal amount of active redemptions from, for example, small growth as you would from small value as you would from large growth, and that those different types of redemptions should offset one another, and in aggregate they would be representative of the cap weighted portfolio, and so that might undermine some of that dynamic. But I think there's a different way of interpreting that because of the current distribution of cap weighting relative to that large growth versus small value dynamic that I think is maybe worth highlighting.
I mean, I think the pushback is basically around the idea of Sharpe's arithmetic, right? Which is that active players as a whole, their net bets have to sum out to the weights of the passive market. That on average, dollar weighted average, they have to net out. And so you can't just have every value investor capitulate and move to passive. It's not possible without also having all the growth investors capitulate. You need offsetting dollars.
Assuming that growth and value are just opposite signs of the same characteristics.
If we totally simplify the market and just say we're going to divide the market in half is growth, half is value, we're going to ignore cap spectrum for a moment, that math doesn't work out. What I would argue is that, let's say we really only had three players in the market: someone who's passive, someone who's growth, and someone who's value. And again, we're just going to assume we're splitting the market in half. The value person is overweight all the value names. Growth person is equally opposite those names in terms of their under and overweights. If the value person wanted to capitulate and the growth person said, well, I'm not selling, the only way they can capitulate to a passive position is if they're able to drive the passive weights up to match those of the growth weights, right? And in doing so, then all of a sudden everyone becomes passive, because you can't just have one active player because there's no one offsetting them. But you can also see that in doing so, they actually drove up the security prices in such a way that in trying to chase that trade. Now, again, we're all saying, well, no trade was done. How does that actually materialize? And it has to do, again, with the prices at which they're willing to execute, because the growth person isn't going to trade unless those prices come up to meet them. And then at which point they might be willing to trade for all sorts of non-economic reasons. Now, I think when we sort of get out of that simplified framework and go to the market at large, it becomes a lot stickier trying to disentangle it. Ultimately, it comes back to this idea that a lot of this is being based upon supply and demand. And that is, there is a lot more supply of small value, a lot more demand for large cap growth. It is ultimately going to change the way in which they are priced within the market. And if those large growth names keep going up and small value keeps going down, there might be folks on the growth side who are necessarily capitulating. They're just taking profit because those prices keep going up. There might be people on the passive side who are trading for non-economic reasons. And there's all sorts of reasons that flow in individual names might occur. But the ultimate idea here is we're not operating in a market that has an individual saying, I think this security is worth X. We're now operating in a market predicated upon supply and demand.
Yeah, which I think we are increasingly becoming hyper aware of the fact that it has always been thus, and that the whole idea of markets being efficient on stock versus being efficient on flows is maybe one of the great misapprehensions in academic finance. I look forward to a lot more literature on that topic.
That was a very sort of eye-opening part of this for me, right? Going back to this idea of versus active versus indexed. If we think, and again, indexed being like a smart beta ETF, if we think all the money in value is in the Russell 1000 value ETF, to simplify the world, that ETF rebalances once a year. So when we think about sort of the influential force in which it is trying to apply impact on the market, all the money that is in the ETF already is just riding. It's not doing anything. It's only at that point of rebalance that it's actually executing an impact on the market. So marginal dollars coming in continue to create an impact, but all the money that's already in that strategy, unless it's being used to rebalance in some capacity, or it's not doing anything. It has zero influence at that point on the market from sort of a supply and demand framework.
Mm-hmm. Yeah, no, absolutely. I don't think you've touched on this in your paper, but we have chatted about it offline. But one of the ideas that Mike Green proposed, which I find especially intriguing, is the idea that the price of a security is set by the marginal buyer or seller, right? So it's a flows, not a stock dynamic. If there's a mismatch between a stock's float adjusted market cap and the average dollar depth of the order book, this could cause a really large, sustained and reflexive distortion in pricing. So just to take an example, right? If you got stock A and stock B, stock A has 10 times the float adjusted market cap of stock B, but stock A only has 5 times more dollar weighted liquidity. Well, as passive flows come in, you're trying to stuff 10 times the flows through a pipe that's only 5 times as large. So, I mean, obviously this is going to create excess buying or selling pressure, right? And this is
which only works in a pro-cyclical reflexive way that in theory you would drive that price up further, and now it's not 10 times, it's 12 times.
Exactly. And then if the size of the order book doesn't grow in proportion, then this mismatch gets larger and larger over time, which causes an accelerating phenomenon in the same direction.
And this is where I have changed my tune on certain things. So in the past, I would have died on a hill where I said smart beta products are active. They have an active bet. How could you call these passive? And I still think that is true to a certain extent. But again, to my point, that all that stock, all the money that's already in the ETF, once it's in there, isn't doing anything. It's just along for the ride. When you think of new flows, well, new flows coming into the ETF, yes, they express a bet that is sort of the prior active bets, but those active bets are now being allowed to drift based upon relative performance of the securities. So again, you go back to the Russell 1000 value ETF that rebalances once a year, and every new dollar that comes in after that is expressing to a certain degree a momentum trade, right? If you put $1 in yesterday and I put $1 in today, my dollar is going to overweight those securities that outperformed yesterday and underweight those securities that underperformed compared to what you bought. Now, we're both going to still have sort of broadly the same active bet, but if you imagine this occurring sort of in all the smart beta products, there is this sort of influential potential of a momentum driven market flow from a supply and demand perspective. And so as the market migrates from when I give an active manager $1, that manager looks at their portfolio and says, well, this stock is overvalued, that stock's undervalued, I'm going to try to net things out, to I try to buy $1 worth of an ETF, and assuming it's large enough, the market maker's just going out and scooping up a basket as efficiently as possible and making a trade with the AP to give me a share. That is a totally different dynamic occurring over time. And again, when you think a lot of these ETFs are rebalancing once or maybe 2 times, at the extreme, maybe quarterly, but that seems to be far rarer. There's a lot more just sort of passive operation that's going on, passive drift, exactly, that's occurring throughout the year.